7 quarters ago, we had published what we then called the watch list, which was at that point of time 22,600 crores. It is now down to about 5,300 crores. So you've seen roughly, let's call it 75% of that watch list slip over the course of the 7 quarters. Slip, or some of it has gotten regularized, but somehow reduction in watch list of about 75% over these 7 quarters. We will keep it alive for one more quarter. At the end of the quarter, we intend to wind this watch list down and mix whatever is remaining at the end of the quarter with our business as usual pool, because the pool is at this point of time, frankly, just not big enough. As I said, the pool is right now about 5,300 crores. You'll probably see a few more 100 crores of slippages from here in the coming quarter, but nothing kind of too huge. And whatever is remaining, we will just, as I said, merge with the business as usual pool.
Also, can you compare the slippages that we saw in this quarter to the Q3 and Q4 last year, and whether the slippages have increased or not? And when we talk about slippages from different accounts, which sectors did you see the maximum slippages coming from?
Sure. If you see our second quarter, of course, we had slippages of about 8,800 crores in the second quarter. Compared to that, in this quarter, the slippages are about one half of that number. But if you go back a little bit and you look at Q3 and Q4 of last year, the slippages were roughly in this range. 4,500 to 4,800 crores was sort of the range in which we had gross slippages in those quarters. So at about 4,400, this quarter is roughly in line with what those quarters were. Of course, the big ticket cases that were stressed have largely been accounted for and recognized as NPA over the course of the prior quarters. We are right now at the next level in terms of size and granularity of the accounts that are slipping. So you will see a few more quarters maybe of slippages at this level before you start seeing them moderate.
Also, when we talk about the provision coverage ratio, that has increased to 600 bips. Do you see that increasing as well going forward, and the pace of slippages reducing further?
What we have said in the past, for multiple years, we have maintained that we believe the sweet spot in terms of provision coverage is somewhere in the 60 to 65% range for our kind of portfolio. Last quarter, we had fallen to the bottom of our range at about 60%. This quarter, we have overshot the top a little bit. We are at about 66%. We continue to believe that 60 to 65 is sort of the sweet spot, and you will continue to see us bounce around in that range a little bit, but nothing much more than that.
Correct. Also, I asked you about the pace of slippages. Do you see that reducing further? And then what would be the asset quality recovery cycle like? Would it move from recognition to resolution and so on?
Sure. The way I'd say this is that as in any asset quality cycle, you start with the recognition phase, then you do the provisioning, and then you do the resolution and recovery. In our case, I believe that the recognition phase of the cycle is drawing to a close. There is still some more to be done, particularly in the power sector. So you will continue to see some pressure from that sector coming up. But apart from that, we are sort of getting there in terms of the recognition side. On the provisioning side, we have been doing fairly aggressive provisioning as and when we are doing the recognition. So provisioning and recognition are sort of going hand in hand, and not one is not lagging the other. As far as resolution and recovery is concerned, you're just seeing the early stages of it, particularly as the NCLT cases start to come to a close in the later part of this quarter and the early part of the next quarter. You will start seeing the next round of big ticket resolution recovery start to come up. As far as the overall sort of guidance is concerned, we guide on credit costs, which we have said for this year will be in the range of 220 to 260 basis points. At the end of 9 months, we are at 250 basis points of credit costs, and we continue to feel confident about the 220 to 260 range, and you will see something in that range for the next quarter.
Also, we've seen a reduction in the margins of the bank. Could you help us understand how would you be able to stabilize that, and by when can we see that stability coming forward?
Sure. If you look at the 9 months to date in this year, we have seen, pardon me, you have seen margin reduction by about 19 basis points. This compares with the 20 basis points of margin compression that we guided to for the full year. So we are well in line with what we think the margin compression in the year is going to look and feel like. As we look forward, there are 2 or 3 favorable movements on the margin front. One is the tightening liquidity situation, which creates a little bit more pricing power for banks. The second is an improvement in our asset quality numbers, which reduces the proportion of our book which is non-interest earning. And third is the higher and stronger capital position that we have, which is also NIM accretive. For all these three reasons, we believe that NIMs should either stabilize around these levels or should start seeing slight uptake going into Q4.
Talking about the loan book, we have seen significant increase in the retail and SME part. Going forward, once the resolution process starts, what would be the kind of composition of the loan book that you see in the beginning of the next fiscal year?
Right now, you see that retail and SME together form about 59% of our total loan book. And this proportion has been increasing steadily over the last few quarters. You should expect that to continue for a few more quarters before we reach stability. So you should expect a few more percentage point increase in that proportion of retail plus SME.
Also, when we talked about the stressed accounts from both the lists, how much do we see recovering and actually resolving in the coming quarter? By how much do you expect that to be there?
See, what I'll say is, as far as the IBC process is concerned and the two lists that RBI came up with, our total exposure to accounts that are entering IBC from those two lists is about 6,000 crores. We have so far made provisions of more than 4,100 crores against that list. So we have a coverage of provision coverage of something like 68%. So unless the haircuts are fairly draconian, unless you see 75% or more haircuts on all these IBC accounts, we don't expect to lose a whole lot more than what we have already provided for. Now, as far as exactly what the haircuts are going to be on the IBC process, I must admit your guess is as good as mine.
So when we talk about the resolution, which sectors do you expect it mostly coming from? And do you expect then that the granular or smaller accounts would be the ones that you'll have to take larger haircuts on, or how would that be?
See, the way I'd say this is, in the NCLT process, as you go through the bidding, one thing is becoming clear that there are some sectors in which the underlying sort of fundamentals have improved, and those sectors you will see greater bidding interest from buyers. Clearly, sectors like steel come to mind as ones where there is a great amount of interest. So you will see in areas like steel or cement, you will see a lot of interest. However, there might be areas or sectors like power where the fundamentals haven't quite improved in the interim period, and there it might be a bit more challenging.
One last question on the budget 2018. So as a bank, what would be your expectations from the budget that will be announced in February?
See, just like everyone else in the economy, we are keenly watching the tightrope walk that the government needs to make between fiscal discipline and growth enablement. The government has been very active in drawing the right balance on these in the prior years, and so we feel fairly confident that they'll be able to do the same. So the fiscal deficit number is the one to watch, and along with that, whatever stimulus might be there for the rest of the economy would be interesting to see as well.
Thank you so much for speaking to Bloomberg, Quint.
Thank you very much.